Good afternoon, everybody, and welcome to Woodside's Investor Site Visit for 2019. For those of you in the room who've joined us here today, thank you very much for coming up and having a look at our facilities both at the Northwest Shelf and Pluto and spending a bit of time with the Woodside team. I'm going to run through a set of slides here today. Questions and answers we'll take from the room here, and of course this is being webcast live. The presentation today should take around an hour at the most, depending on the number of questions. The actual presentation time actually will be short. I know you'd prefer questions and answers, and of course we'll limit the questions and answers to things germane to Woodside, hopefully. Normal disclaimer and important notice. You'll notice it's getting smaller and smaller, so we're quite proud that we're actually able to get the important things down there to half a page. But it's read through that. Of course, the key thing for us, particularly those on the webcast, is that we are denominated in US dollars. So everything I talk about today will be US dollars unless I say something differently. Let's quickly look at what Woodside does. Firstly, of course, we rolled out our three investment horizons for our business a couple of years ago. This has been important for us as we think about how we actually grow the business. The first part of that was what we call Horizon 1 from 2017 to 2021. That was really about generating cash and getting the business ready for the very large investment cycle that we've got in front of us. Of course, we're in 2019 now, but we haven't reset the start of that. We've said, let's stick with this cycle, then people can see as we actually move through each part of the investment. And that's going very well, as you know. Cash generated in the business is very good. If you have a look at some of our metrics, are very good. Things like gearing ratios, things like our investment grade and so forth have all held up very well. And of course, we had an equity raising last year with the acquisition of the Scarborough project or the Scarborough resource. So you can see this cash generation period is good for us. And of course, we're getting now prepared for that next phase, which we call Horizon 2. Horizon 2 is the execution part of it, but it's also where we'll start to see some of our projects start up, particularly the Scarborough project will start up in Horizon 2, and at the back end of Horizon 2, the Browse project will start up. So you can see we've got that moving. And then we're starting to prepare ourselves for Horizon 3. At the moment, Horizon 3 for us is really focused on Kitimat and on Sunrise, but we're looking at other opportunities as well in Horizon 3. Creating the Burrup Hub. We've talked for the last 18 months or so about our vision to create a hub at the Burrup, and of course there's been a lot of discussion both within industry and the media over the last 2 to 3 years about ensuring that we utilise existing infrastructure. That's really the smartest thing to do. It's often very difficult to do with different ownership structures across unincorporated joint ventures or incorporated joint ventures as they may be. But nonetheless, Woodside set about doing this. And the advantage that we have, of course, on the Burrup Peninsula is we're operator of the two main assets. And so we should be able to pull those two assets together, even though the ownership is quite different between the Northwest Shelf and Pluto. The hub itself really consists of the backbone of the existing plants, along with an expansion of Pluto by putting a second train 2, on the Pluto site itself. Those two plants being fed by new resources, coming firstly from Browse down to the Northwest Shelf, and then for Scarborough coming in through the Pluto plant itself. And then finally connecting the two plants with an interconnector or a pipeline between the two plants where gas can flow either way depending on how the plants are set up on a particular day. So that's what we call our Burrup Hub vision. I can tell you today the engineering is going very well, as you would expect. The costs are coming in as expected. We'll know more as we go through the year as we get firm costs coming in, but at the moment the costs are as we expected. And of course the hard part about it is the commercial negotiations, and of course somebody told me the other day that's what the last minute is for, and that's generally when commercial negotiations get finished. So it's a long process, but it's an important one for us because those commercial negotiations set the framework for the operating of these facilities for the next 30 years or so. So it's not something that we want to rush into. Our growth strategy, of course, is focused on 3 areas: operational excellence, capital efficient developments, and our long-term focus. We're known for our low cost and high margin. Safety performance is excellent within industry, particularly here in Australia, and of course globally competitive cost of supply, and we've maintained that over time. I've already talked about capital efficient use of infrastructure around utilising existing assets. We've always focused on world-class assets. Often, of course, people have asked us, why don't you go after some of the other smaller assets, shorter life assets? That's really, to be honest, our mandate is to go after world-class assets. There are more resources that we need to understand. It's not simply about the resource in the ground, it's the human capital as well, and we believe it's more efficient for Woodside shareholders to have the human capital deployed on world-class assets than it is on some of the smaller assets that may come up from time to time. We are in a commodity business, so we do go in cycles. I know a lot of you will probably want to talk to me about price today. We can't forget that the thing that keeps costs down is price. And so we would love a world where prices were high and costs were low. That world only exists once you've spent the money. That world says that you actually have to spend money while prices are low, because that's actually what's keeping your costs low during the construction part of it. So we would love that, but if you're a true believer in the commodity cycle, you're a true believer in the commodity itself, then you have to often make very difficult decisions when price is actually at the low point in the market to lock in costs, because that's when you actually can get margin and true margin in the business that is above the long-term average of the business itself. We've been working hard on our project delivery. You'll hear a little bit today about our Greater Enfield project, which is one we're proud of. She's back on station and going through commissioning. I'll just talk about that in a moment. Of course, you heard about Greater Western Flank 2. They're small projects, though, relative to what we're about to take on, and so we've been preparing ourselves with the world's very best contractors and ensuring that we have the best teams in place, because we know what we've got in front of us is quite a challenge. We've also focused on the long term in our business. Those on the tour today would have seen a little bit around our innovation and technology. So you would have seen kind of boots on ground, what we're actually doing. Of course, the smarts in the system are all behind there and the things that you can't always see. But I can assure you, Woodside is a technology company we're a company that goes well beyond the normal deployment of oil and gas technology that you think about. We're deploying contemporary technologies, and we're actually world leading in some of the deployments of those technologies. And then finally, of course, enduring community partnerships. And of course, the big one on the Burrup Peninsula is the Murrujuga Corporation. It's a organisation we're very, very pleased to have an excellent partnership. But we have a number of those partnerships around the world, including in Senegal, Myanmar, and of course in Kitimat in Canada. I want to talk a little bit about technology. You haven't heard a lot of this from Woodside and what we're doing. It's about developing what we call intelligent assets. So it's moving and starting to use our data analytics, our automation and robotics in a very, very intelligent way on our assets. And it's setting those assets up for the future. Now, of course, what does it do? It allows faster, better decision making. It also takes people out of hazardous areas of our business, and it also means we can deploy our people where they are most efficient in our business, ensuring that they are focused on the things that they need to when they need to be focused on them, and that we have critical mass of people in certain places to be able to monitor the systems and basically let the plant run themselves. You can see a little diagram up here around sensors, the insight we get from those sensors, and then an action, and of course that's a do loop that we keep going through. What does it do? It delivers faster, better decision making. It delivers very consistent decision making for our business. One of the issues we see in a manufacturing business is every 12 hours there's a new set of decision makers come on shift. And we see that in our plant, we see that in the operation of our plant. It's even more difficult when you go into remote operations and you get into FIFO workforces. It could be away from the workplace for 4 weeks or more, and then you put them on shift again to run your plant. The human interface is a very important one. Through using these systems, these smart systems, it's taking that uncertainty or variability out of that human interaction and lifting it up and up, up and up and up. And of course, it's about making sure that we can maintain our cost competitiveness in the future. On projects, Greater Enfield and Najima Yin is back on station, so she's hooked up, going through final commissioning, so we're pleased with that. The project's over 90% complete at the moment. We've drilled 10 of the 12 development wells. The good news is the resource is coming in as we expected. As I mentioned, offshore commissioning has commenced and we expect her to start producing in the not too distant future. So good news there on the Najima Yin. It's an oil project for us. It'll be good to have oil coming back into the portfolio, and of course it sets us up for what we were trying to achieve previously. If I can just finish on the Najima Yin, because we didn't talk about cost. She will come in under cost, so she'll come in under schedule and under cost. This will be the first time Woodside's delivered a FPSO refurbishment on schedule and under cost. So it's a very, very important milestone for us. These are notoriously difficult refurbishments to do, and often the work in the shipyard can just grow and grow and grow. So we're very proud of our team that we've been able to get out of the shipyard with the vessel complete without very much follow-up work at all, and to be able to get her on site and get her up and running. Upcoming milestones, of course, Scarborough and Pluto LNG Train 2. We'll have a gas tolling agreement that we'll execute with BHP. We'll complete the Scarborough feed and, of course, the LNG Train 2 feed with an FID target of 2020. So those first three items will be 2019 and with an FID target of next year. Browse to North West Shelf. We're plan to execute the gas processing agreement this year. I know you'll have some questions for me on that. We'll reserve North West Shelf capacity for Browse. We'll commence feed. The partners are committed to commencing feed at Browse by the end of this year with a late 2020 FID target on that. And then of course SNE in Senegal, phase 1 will go to FID in the second half of this year. And of course we're maintaining our target 100 million barrels of oil equivalent annual production for 2020. So we're pleased to do that. Okay, that's the end of the formal presentation. With that, then I'll open up to questions from the floor. Yes.
Thank you. James Redfern from Bank of America. Peter, can you please talk about the discussions with BHP in terms of the tolling agreement for Scarborough and Pluto, where there's any sticking points there, because obviously BHP would prefer a lower processing fee or tolling fee and Woodside a higher one. And any risk to the timing on that slipping into 2020?
Yeah, look, the discussions around the toll are actually very well advanced. The major sticking point at the moment is just we have a difference in what the price should be. And so for us, that's a natural sticking point, so not surprising. I think also we need to get some certainty around what's happening at North West Shelf, because of course if it eventuates that Browse doesn't go ahead, and I don't see that happening at all, but then of course Scarborough would go through North West Shelf as a preference rather than building a second train at Pluto. And so we just need the North West Shelf discussions to progress as well to a point where the Scarborough partners are comfortable that we can go say yes, let's move on Pluto Train 2. But at the moment it's just simply around an agreement or a discussion around what sort of rates of return Woodside should receive for the building of Train 2 and their view. Our view is, of course, we're an upstream company, so we need upstream returns. And of course, we're taking disproportionate risk because at the moment we're taking on the building of the train. Now, we're trying to minimise that risk by going to fully wrapped lump sum contracts, and we'll know, early fourth quarter what the pricing on that fully wrapped lump sum contract on Train 2 will be. So it's just price. The good thing is we have the same dollar number in front of it. Any other questions? Was that a question, Ben?
No, but I
Yes, please.
Peter, you mentioned LNG supply, and you keep referring to a looming supply gap. Can you just talk a bit more about the market with specific reference to US projects? They seem to only be gaining momentum, and every time we hear more from another one, prices are coming down. So how do your projects and contracting fit into that dynamic, and with specific reference to the supply gap that you're referring to?
Yeah, look, I'll come back and separately talk about the US projects. We saw, 12, 18 months ago, I would have said to you, we saw a supply gap coming in 2021, 2022 sort of time frame. And so we were comfortable with that and saying, look, we can go to FID on our projects with only 50% of the volumes contracted. And that was just simply saying we think the market will come to us at that point in time. And we certainly didn't want to send a signal to the market that we needed a certain amount to get away, given the strength of our balance sheet and the fact that even post-FID, there's 3 to 4 years to go and sell the gas. So we saw there was a period of time where we could make sure that we were fine in the marketplace. What's happened in the last 12 to 18 months is you've seen a couple of very large projects go to FID without having sold the gas. And it's moving into portfolio, and we're seeing more of that. In fact, we're seeing competitors actually underpin other companies' projects, not just their own projects, and that's happened in Mozambique. That has raised some concern with us around that, because it's not that the supply-demand gap is not there, it's that suddenly everybody will be in the market at the same time trying to sell. And that's why we've said from day one that we really need to move as quickly as we can on Pluto and on Scarborough and on Browse, because there'll be a period of time where there'll be more competition in the market, and that competition is now there. So our view now, and of course our direction to our gas marketers, is to go out and put as much under long-term contracts as we can, and to have that linked to oil pricing if we can. And so those conversations are quite advanced. Now, so that's a difference. That's a difference. Now, of course, what we're saying though is we're still comfortable to go to FID with a lower number, but certainly by the time the project starts up, we want to make sure we're well contracted. But I'd rather do it up front, to be honest with you, Ben. With respect to the US, the US it's an interesting one, because all of those projects need to be project financed. So you saw the one that moved was the one that didn't need to be project financed, and the company could do it off its own balance sheet, and they're an aggregator where they're actually taking gas out of the system and then selling it to others as part of their tolling structure. I think it'll come down to eventually what happens between China and the US, and as part of that trade deal is LNG a large part of it. The answer is it was 12 months ago, and of course some of those companies signed MOUs, HOAs on purchasing gas out of the US. Of course, they haven't made their way into sales and purchase agreements yet, and they're unlikely to, because of course there's now a security of supply issue overhang on behalf of the Chinese when they're looking at US volumes and saying, actually, what will be the price and will it turn up on the day? We just don't know. And until that's resolved, of course, it's difficult to sign a sales and purchase agreement for them. So I think those projects will just sit there, and they'll be waiting until there's a trade deal done. And then I wouldn't be surprised if one or two of them move forward fairly quickly after that. At the moment, of course, they're flooding the European market, and but it's only a matter of time before some of that gas starts to make its way around into Asia and further. So we are concerned about it, there's no doubt about it, but again, it just says, get your projects moving, because I mean, you can sit in the sidelines of the pool and be concerned about what the temperature of the water or whether it's too deep or not forever and never get in. So, this is not a world where for faint-hearted. It never has been in the resources industry when you're making large capital decisions. So you want to be sure that you're measured in what you do, you want to be clear on it, but nobody's ever going to gift you anything. Nobody's ever going to come and say, we just want you to build the project and we're going to give you a return that's above industry. You're going to have to work hard for it. So we do watch it carefully, but again, it just says we've just got to keep moving forward to be able to compete with that group. and be in there. That's where it says you've got to keep your cost base low as you can. You've got to remember, and this is often forgotten in the conversations, there has only been one developer in the US Gulf Coast who's actually built to cost and schedule. Right, so we talk a lot about how expensive Australian projects are. There's only been one company that's built to cost and schedule, and that's been with one contractor. Right, so there's a couple of pretty big overruns sitting there that would make your eyes water even in Australia. Yes, sorry, we've got a question in the front.
Philip Wensley from Paradise Investments. Can you talk to the cost base of just the existing assets and then just how that changes with the expansion assets?
The cost base actually goes down once the... there's two parts to it. So the expansion assets have a development cost base that's lower than the existing cost base. So that's the good news there. Of course, the challenge there is how quickly we can move proved plus probable reserves or probable reserves into the proved base. So you can see that in the depreciation line. But the actual development cost base on a 2P basis is lower than the installed cost base today for Woodside across all of our assets. So that'll include some oil assets as well. But if you look at us as a company, we actually go down a couple of dollars on the cost base, which is unusual. So most people are thinking the costs will go up. No, actually, it goes down. From an operating cost point of view, Northwest Shelf will benefit from browse coming through the plant, and it will benefit in two ways. First way, it will share in operating expenses. So basically, as you start to look at Northwest Shelf going into decline, then of course there is some equipment that you just have to maintain, whether you're at 100% capacity or 60% capacity. Browse will share in that cost because it will be on a proportionate capacity basis. And so that's a real plus for the remaining resource at Northwest Shelf. The other part, of course, is browse will contribute to the life extension of the Northwest Shelf to be able to produce the browse resource. Now, of course, there's going to be some synergies there with capital that you would also have spent at Northwest Shelf. It'll be difficult for us to see where that is on the margin, but certainly having the same project teams in place and so forth, there'll be some capital efficiency from that as well. The actual operating costs of Scarborough will be a little bit more expensive than Pluto offshore because it'll be a minimum manned facility, so you've got equipment on the offshore, whereas you don't have it on Pluto offshore. So Scarborough will be slightly higher from an operating cost point of view. And then I don't think we've given any numbers out on browse, but browse is not too much different to where we're operating the Northwest Shelf. Yes, James.
Peter, James again from Bank of America. Can I please ask about the 4.5 million tonne interconnector between Pluto and Northwest Shelf? Have you provided any CapEx numbers for this interconnector? And then the second question is, the first 1.5 million tonnes will come from Pluto. So I'm wondering, does Pluto have the capacity to produce 6.5 million tonnes at the moment to put 5 into train 1 and 1.5 into the interconnector? Thanks.
Good question. So just on interconnector costs, I don't think we've provided guidance, but you read it's in a couple of $100 million. Most of that cost is not in the pipe, it's actually in the facilities at either end. So that's on a 100% basis, not on Woodside. That's going quite well, and we expect to go to FID on that project sometime later this year. With respect to the capacity of it, it is sized, or the pipe sized for about 4.5 million tonnes. The end facilities won't be sized for that on day one because we didn't want to overbuild. So they'll be in the 2 to 2.5 million tonne, and if we have to go up to 4.5, then we'll just in parallel put some more facilities. We wanted to do that because we only want to bury the pipe once. We can put facilities in relatively easy, but once you start burying pipe underground and running through easements and so forth, it is a limited easement space, so we only want to do that once. With respect to Pluto capacity, we are spending money in the offshore now, actually accelerating the drilling of some wells. We're doing that because at Pluto, and we're doing that because we think it's a non-regretted capital spend. Drilling rates are actually still very, very low. So we're trying to lock those in. But that's capital that we would have spent anyway in the development of Pluto and the Pyxis field. And so we'll go to FID on Pyxis later this year, but we're drilling the Pluto 7 well as we speak, and we've ordered long lead items for the Pluto 8 well. So we accelerated Pluto 8 and we've accelerated Pyxis. We believe both those wells will give us capacity to be able to put into that interconnector. Now what we don't know is whether we'll be able to get up to the full 1.5 million tonnes. There's some process engineering work that's being completed around how much can the Northwest Shelf take of that gas. We think it's in that sort of range, but we won't know until we start flowing it. So we will have the capacity there, but simply what we're doing is we're spending money early to bring forward cash flow and lock in costs now that we know we would have had to have spent in another 2 to 3 years anyway. So we get efficiencies out of doing that.
Thanks, Peter. Chris Mulby at Macquarie. Just on the pricing side of things as well, you're starting to see a lot of buyers diversifying their price mechanisms. You keep talking about slopes for Scarborough gas. Are we looking at it the right way and looking at slope continuously, or are you looking at sort of JKM or Henry Hub link pricing for that as well?
We're certainly not looking at Henry Hub. Our view is, and the reason we got into Corpus Christi is that if we're going to sell Henry Hub, we can sell Henry Hub directly, and we think buyers have that option today that they didn't have previously. So the hybrid contracts is something we're trying to steer away from where we can. And to be honest, there's only a handful of buyers who want to talk to us about hybrid. The majority of buyers are happy today that there's enough liquidity in the marketplace that they can actually go and get cargoes themselves from any hub or any linkage that they decide. We're obviously still a Brent/JKM company. That's where we'll kind of push our contracts. Some of the buyers prefer JKM. That's a limited pool because, as you know, over time, once the market becomes the major thing that you go after, then of course it all goes to one, right? So you actually don't get a marker over time because there's no difference in the price. So we look at that. We think Brent still works for us, and it works for a lot of buyers. With respect to slopes and so forth, we're seeing the marketplace today. Slopes are, there's some pretty low slopes out there. Typically, you can get medium contracts away on an 11.5 plus, so anywhere between 11.5 to 11.8. There are some pretty competitive long-term contracts out there at the moment that might go slightly lower than that. It's going to be hard for you to analyse them because there are more and more buyers wanting seasonality in the delivery of cargoes. And so you've got to be careful about the headline slope because it'll also depend on seasonality and if they've put seasonality into the delivery. We kind of like to split that up because we want to take advantage of the winter upside as well, but also manage, of course, through the northern summer downside on that. So you'll find each contract is, if you can put a little bit of flexibility in there, then the buyer's willing to pay just a little bit more, particularly if you're willing to resell the cargo if the buyer doesn't need to take it. Mark. Oh, sorry.
Thanks. Sorry, Duncan Simmons at Wavestone Capital. I guess just one thing I wanted to follow up is there any change in your ultimate equity ownership of Pluto and Scarborough that you've discussed before with us with this changing long-term kind of contracting structure? Thanks. And where are you kind of, I guess,
right
along that path?
Right, so I think there's two steps in that particular question. As you know, we've already indicated we're in the marketplace looking for buyers of Scarborough upstream equity, and that also we'd prefer buyers who take that equity through Train 2 as well. So that's the first step of the process we're going through at the moment. We've had people in the data room. We've stopped any more people coming into the data room simply because at the moment, until we have agreed a toll with BHP on Train 2, then of course we don't have a complete data set for them to be able to evaluate the assets. So that's where that is at the moment. So once that toll is agreed, then we'll go back to that original group, and then we'll allow others to come through that data room process for us. with respect to longer term then, so that's the short term. Longer term, what are we looking at? We are looking then at a different ownership structure of Pluto Train 2. So I'm not banking on that. So all of our financial forecasts are based on us holding the train and holding the equity in that all the way through. But we are looking, once we get these, all of these agreements in place, for ways that we can start to release capital out of the business. And that's, in the first instance, that'll be Train 2. That's the most obvious one. We've also had a number of approaches on Train 1. We have to look at that and see if that makes sense to us, because of course Train 1's a very large cash generator for us at this point. So I'd be loath to play with that cash generation at the moment unless it had a compelling reason to do that. And then of course there's the perennial question around ownership structure in North West Shelf and so forth, and as to whether we need to maintain ownership or control over time. And I think they're all questions that we're certainly looking at, but we're not actively progressing at this point, because the first step is get the project structures in place, know what it is that you're selling, and then start to work out what that best structure is. But I think the key here that you can take away is we want to make, we're going to become very capital heavy in the business. We want to make sure we start to improve our ROACE and release capital out of the business the best way we can. That also helps us for future capital requirements if we can release some capital out of the business as well, and turn that over to people who may have a lower return threshold than we do. But that's next steps. Next steps. I hear some superannuation funds like that stuff.
Peter, it's Mark Brusatil from JP Morgan. Just I wanted to drill down on the comments you made around slopes of 11.5 to 11.8%. Call it 11.5 to 12%. I'm going to say 5 years ago you couldn't make that work for a greenfield project. If you think about where we sit today, what is it that's allowing projects to go ahead at that price? Is it lower capital costs? Is it a lower cost of debt, or is it just purely on the equity side that it's either high risk or low returns?
That's a good point. Well, I think there's two parts to it. One is you run those slopes, and so we run the economics two ways. We run those slopes flat, and we also run, we've said to you previously, we run Brent at $65 per barrel flat, so flat real, not flat nominal, flat real. And so that's the test for us on investment these days. It's a pretty difficult test, and of course you start to get down to double-digit rates of return, but you're not mid-teens. So you're not going to get an LNG project with mid-teens at that sort of pricing structure. But it does allow you on the cost side to get comfortable that you can invest. And then you've got to believe at some point you're going to benefit on the upside. So as I mentioned, as we talk about price today, of course we're in the dip, and it's not going to look good, but that's why cost is down. And so that's why it's important for us to maintain that linkage to Brent as well, because a dollar difference in the Brent price has far more impact than a 0.1% difference in slope. So the Brent crude price is actually the main differentiator here. We talk about slope a lot, but we're used to the days when slope was 14-15%. Those days have gone, at least for the next period of time. So as we look at the projects, we're saying model them next 5 years at these sorts of numbers, because that's where the market is. Make sure they're robust, and then allow yourself to start creeping back to what you think the longer term is. But it's good for us as well, because it provides a real discipline in the organisation, particularly for the projects teams, because they know what they need to deliver around cost and schedule. So again, as you know, bad habits can get into the system when people think that price is always going to rise. It's a completely different mindset and discipline in the organisation when people can see that no, prices aren't going to rise necessarily, and that you have to deliver on your cost and schedule expectations.
Hi Peter, James Byrne from Citigroup. Going to hold on to the mic, so I've got two questions. Right. Really, the first is, it kind of sounds like everything's hinging on the tolling agreement between Browse and North West Shelf, because that then gives you certainty around where Scarborough goes and so on and so forth. So an update there, please.
Sure. So a couple of things. So we said we were hoping to get that gas processing agreement done by the middle of the year. Well, unfortunately, we're not. But that was a two-step process, so don't despair. What the partners had agreed at the beginning of the year is that they would go through a two-step process, which would be firstly to develop a generic gas processing agreement that anybody could come into, and then develop a Browse-specific agreement once the generic one had been completed. Well, we've gone through 6 months of negotiation, and basically one of the parties has said, look, we just need to go back to where we were in January, February. They think we've wandered, so we just need to come back and just reset. So we're in the process of resetting, but the commitment from all parties, including the party who wanted us to go back and reset, is that we will have this finished by the time we need to go to feed on Browse. The Browse partners have committed to go to feed by the end of this year. So everything is lining up. It just says we missed that middle process. And of course, on reflection, people are saying, why did we go through that middle process? It was because other projects thought that they would get into the queue in front of Browse. There is now a commitment from all of the North West Shelf partners that Browse, in fact, will be the anchor tenant at the North West Shelf, so we can just kind of jump that step of developing that generic gas processing agreement and really now just get back and focus on Browse. So it's not somewhere where I wanted to be, and it's certainly not somewhere where our commercial teams wanted to be, but it actually is exactly what happened the first time we negotiated the toll on North West Shelf. So it's not surprising, it's just disappointing we didn't learn from the last time. We have to do it again. But sometimes, you have to do things the same way. There's been a bit of a change out in the negotiation team on a couple of the players as well. So, of course, fresh eyes come in and they've got to take some time to get up to speed. But I think the key is disappointing that I can't announce that it's done now, but that would have only been the generic one. The specific Browse one would have still had to be negotiated. So everybody's now agreed. Put the generic one aside. Let's focus on Browse. What's good for Browse will then be good for all of these other projects. And the key then is the Browse partners are sitting there saying, we're committed to go to feed by the end of this year.
The second thing I wanted to ask about was price reviews for existing contracts. What are you seeing across the market? Are things typically pricing at the bottom of the tolerance range? Do you think that there's much of a risk that buyers test arbitration law given the discount between a prevailing market price and some of these historic contracts? And like if we look back what happened 10 years ago in Europe, that's exactly what happened. Like the European utilities took all of these contracts into arbitration. The arbitrator ruled in favour of the utilities, right? So I just wanted to get my head around some of this risk going into price reviews.
Right. I would tell you, I think it depends on where the buyer is from. With respect to their willingness or their appetite to go into arbitration, and it would also depend on the linkage that they have. So the vast majority of our contracts are with Japanese buyers, and so they're a counterparty that very much prefer to negotiate rather than arbitrate. So arbitration is a very last step for a Japanese buyer. The contracts are pretty clear as to what the linkage is, and of course it's to the average landed price in Japan. And so we always need to look at average landed prices, not at spot or market prices on a particular day. And we've been through this many, many times. So North West Shelf has 13 contracts. 3 or 4 of those contracts are open every year for price negotiations. So we're aware of that. Doesn't mean there's not downward pressure on prices. There's no doubt about it. And as the buyers go through those price reviews, of course, they are trying to look for other ways, particularly around diversion clauses and so forth, that they can sneak in. And we'll accommodate that where it makes sense, to be honest. On Pluto's obviously the big one for us. We're currently in price review negotiations with Pluto. I don't expect any news on that in the near future. The negotiations haven't progressed to that maturity there yet, that I'm actually seeing something on my desk, for example, for me to review. So that says we're a few months away from having any news on Pluto as well. Simon.
Thanks. Just speaking of arbitration, and I know this is quite off-piste from the LNG discussions we've had, any update on Senegal?
Simon Mawini. Yeah, look, the thing on Senegal is the arbitrators have set a hearing date, so and they've set the rules for the arbitration. So both meaning the witnesses that will actually go before the tribunal, and also the period of time over which that will take place, and also they've set the dates for that, and that's in the next couple of months. But it's an arbitration, so we're going through a process. Yeah, please. I will tell you all of Woodside's submissions to the arbitrators were accepted.
Chris Morby again from Macquarie. Just on PRRT side of things, last year under the review they said they were going to do a 12 to 18 month transfer pricing understanding. How can you make a decision on sort of going into FID on Scarborough until a decision on that is made by the government?
Look, it actually works two ways. The Australian government has a long history of not reopening deals that have already been done. So there's actually an incentive for Scarborough to get moving and actually get in under the current rules, because the Australian government then won't force retrospectivity on anything that comes through. So those conversations are being held with Treasury at the moment. And I don't have a timeline on completing it, but our tax people are part of those conversations. But no, it's actually the other way around. The actual incentive is to get out there and you'll get under the current rules. That wasn't lost on us. James.
Thank you. James from Bank of America again. Just going back to SNE and Senegal, FID is targeted for the second half of this year, but it sounds with the arbitration and joint venture partners seeking to sell down equity that has a risk of slipping into 2020. There's a lot of moving parts by the sounds of it. Is that a fair comment?
Well, I think, firstly, I can't comment on the partners selling down equity. They need to make those comments themselves. The arbitration is real. The arbitration is affecting the project financing. There's no doubt about it, because the project financiers want to know who actually is in the joint venture. That's important for them, because that then pertains to the risk that they have for their financing. And if Woodside's in the joint venture, that's great. If Woodside's not in the joint venture, then they'll find it very difficult to project finance the project. So that's key for us at the moment. So that's kind of why things are moving a little bit within the joint venture. Having said that, the joint venture partners, in my view, are as motivated or more motivated than Woodside, because particularly for at least one of them, it's a single asset. And equally, the government of Senegal is very motivated to move forward with it as well, and they're a partner in the project. So again, an advantage here is the government is a partner through Petrochem, the state-owned company. So there's still momentum within the project, but the key one, James, is the project financing.
Mark Bruce-Still from JP Morgan again. In the face of a lot of criticism, you sort of maintain that 80% dividend payout ratio. Was it last year when you did the equity raising, and given where 10-year bonds have gone, it made to look, you guys look like geniuses now. But the question is your commitment to keeping that level of payouts. I think you had talked in the past about how the register would maybe change over time, and then you would reconsider it. But where are you at with the payout ratio on the dividend?
Well, I think the key to that is I need to invite you to our AGM, and you'll meet a few shareholders who have a different view than the one just expressed with respect to we should lower it, and they clearly want to keep the dividend where it is. I think the key, Mark, and I've said this consistently, we'll maintain it as long as it makes sense to maintain it. The trigger would be if suddenly we change the nature of stock and change the nature of shareholding, but it would have to be a significant change for us to get through that. So at the moment, as you know, it's driven by the tax rules in Australia. It's beneficial for our Australian domiciled shareholders, very beneficial for them. And so it's something we can do based on the strength of our cash flow. No, it's not something you would usually do, and you wouldn't see it in other jurisdictions with different tax structures, but it makes sense here, and so we're just taking advantage of the tax structure for our shareholders to get the profit back to them, to be quite frank with you. So we're working very hard to just maintain it where it is, but we won't, if there is a change, then we'll of course signal that well ahead of the game. But no, it's very highly prized by a lot of our shareholders, and so therefore it's a good discipline for us. And I've always said, for the incremental amount of cash that is, remembering half of our cost structure is non-cash, so we do free up. You've got to look at the cash equation, the cash side of the business, the cash cover as well. It's not simply looking at profit. You look at that, and you look at the money we're spending overseas, which of course, will change over time as well. It just makes sense for us to hold it at 80%.
Peter, I just wanted to follow up quickly on an earlier comment or question about the Pluto price review.
Yep.
When you do get a finalisation of that, do we expect that to be the backdated? I think I recall you originally talking to a maybe reset earlier on this year, and you pushed that out. When is the actual date that would apply, that review? Yeah, well, the price review itself is, I think, is from the new period, which is what we call price period 3, starts April, May this year. So that's the new price period. So the negotiation is, what is the price that we received during price period 3, that being another 5-year period. Whilst the negotiations are underway, of course, we continue to receive the price in price period 2. Now, what happens at the end, what sort of adjustment is made, is then also a negotiation at the end. So, if it's finalised this year, for example, and we're confident that it's finalised, then it will be adjusted for this year. Of course, if it slips into next year, then of course, then this year won't be adjusted, so to speak. We may go back and do that retrospectively as part of our profit, but no, actually, we don't believe that we would adjust at all. But it's a negotiation then actually as to how the adjusted price actually rolls through to the cargoes and so forth. So it's not linear. It's not that we have to write a check and send it to the buyer in the mail, so to speak. It's generally an adjustment around the pricing for the future cargoes and so forth that we do that.
James Gurry from Deutsche Bank. It was said that Scarborough was potentially gas that was only going to be destined for China at one stage. Can you talk more broadly about the buyer interest that you've got and whether it will flow through to equity or not?
Yeah, it's a good question. Of course, 5 years ago that would have been the case definitely. But of course, there are some pluses with both the US coming onto the market, and particularly the east coast of Australia, and in the future Mozambique. Is both the east coast of Australia and Mozambique are very, very light gas, and so the buyers, the Japanese in particular, have established facilities now that they can actually spike that gas to get it up to sales quality or pipeline quality within Japan. Those facilities didn't necessarily exist 5 years ago, and so Scarborough then was a gas that pretty much could only get into either the Indian market or the China market, because they can mix the gas in their systems. With respect to equity, that's really not driving equity decisions as I kind of look at the potential buyers. It's not biasing it one way or the other at this point. So I think most buyers have got all of the options that they need these days to take a Scarborough quality gas. We've got a couple of options as we look at optimising over time. The initial sales might be a Scarborough alone. In the future, we may actually start to mix it with Pluto gas as well. So we've just got to look at the price differential that may cause on the Pluto gas if we mix it, and what market that will go into. But that's an optimisation that we'll look at. We're currently valuing it for the project simply as Scarborough alone without that mixing opportunity. Any more questions? A couple more. You're doing pretty well. We've got
Just
10 minutes left.
One follow-up then. Would you go ahead with Scarborough at more than a 50% share in the project for yourselves?
Yes, yes, we would. Yes, we would, and we've said we'll do that. So it's an investable project for us to move forward with. So we're comfortable at that. Obviously, one part of the capital sell down, or the equity sell down, I should say, was to manage future capital requirements for us. The other part was, of course, to try and attract customers for the gas. So there's two parts to that. But if we're not comfortable with it, then we'll have to do the capital part in a different way.
That's what I was going to ask, but maybe you can just expand a little bit, just talk about the range of flexibility around the 50%, what sort of outcomes might lead to higher or lower numbers.
Well, of course, as we ratchet down, today we hold 75%. We can't speak for BHP, but they've got an option to take another 10% and of course remit back to us costs and of course the buy-in position for that. So we could, if BHP do exercise that, of course then we're down to 65%, and so we're looking at a 15 to 20% equity sale then. So it's not a big leap. I would tell you most of the people who've been interested want more than that. They want more than that. And I'm happy to go a little bit lower, but I don't want to go too much lower. It's really hard to get a good project, so you don't want to sell it before you actually start developing it. So these things take a while. All right, if we don't have any further questions, again, look, thanks very much, firstly for your questions in this forum, but very importantly also thanks for taking the time and effort to come and join us up in Karratha today and to tour our plants, not only to see the plants themselves and to get a better understanding of what it is we do and how we do it, but also to be able to see the new areas where Pluto Train 2 will be sited, where the interconnector will run and so forth, to kind of give you some confidence that there is very minimal construction work that will need to be done to prepare that site, which is a real advantage for us as we look at Train 2, how that will all be managed. And then finally, you've got to meet our people, some of our leadership team, and I hope I'm sure you'll walk away with a very good impression around the quality. Of course, I can't finish this without mentioning we've got a MasterChef contestant in the room, so I know you'll all want autographs on the way out. So again, thanks very much everybody for your time today. Thanks for those who've joined the webcast as well. We very much appreciate the time that you put into us and your support. Thank you.